It begins not in a gleaming skyscraper, but in the thick, smoky air of a 17th-century London coffeehouse. Long before any formal exchange existed, the City of London's centre of commerce, the Royal Exchange, had actually banned stockbrokers. They were seen as too loud, too uncouth. So they took their business to the bustling coffeehouses of Exchange Alley. This was the wild, unregulated infancy of the UK stock market. In 1698, a man named John Castaigne began pinning a list of prices for stocks and commodities to the wall of Jonathan's coffeehouse. This simple sheet, the course of the exchange and other things, was the first real step towards an organized market. But it was a chaotic environment, rife with fraud. If you lost money on a bad deal, there was no one to appeal to. The need for rules became painfully obvious. Finally, in 1773, a group of 150 brokers clubbed together, left Jonathan's, and opened a more formal stock exchange in a new building. Then, in 1801, the London Stock Exchange, as we know it, was officially born, with a subscription room, a formal rulebook, and a mission to bring order to the chaos. The 19th century was the market's golden age. Fueled by the Industrial Revolution and the vast capital flows of the British Empire, London ascended. The railway boom of the 1840s saw a surge of new companies listing their shares, and the LSE became a firehose of capital, funding projects across the globe. By the eve of the First World War, London was utterly dominant. It was the largest, most important stock market in the world, listing nearly a third of all public securities on the planet. Its position seemed unassailable. But the 20th century brought world wars and new rivals. By the 1980s, London was looking old-fashioned. Trading still happened through open outcry, with brokers yelling orders across a crowded floor. It was a closed club dominated by tradition. Meanwhile, exchanges in New York and Tokyo were embracing technology and aggressive competition. London was losing its edge. Then came the shockwave, October 27, 1986. The Big Bang. In a single day, the Thatcher government blew the old system apart. Three fundamental things changed. First, fixed commission charges were abolished. Brokers now had to compete on price. Second, the historic separation between stock jobbers, who made the market, and stockbrokers, who acted for clients, was eliminated. Firms could now do both. And third, and most crucially, the exchange was thrown open to foreign ownership. The effect was immediate and brutal. The old, independent British firms were almost all swallowed up by huge international banks. This was dubbed the Wimbledonization of the city. London hosted the world's premier financial tournament, but all the top players were foreign. Yet the Big Bang worked. Trading volumes exploded. The move from shouting on a trading floor to silent, electronic, screen-based trading was revolutionary. The City of London solidified its place as a modern, global financial hub. The old boys' club was dead. The decades that followed were defined by this new high-octane environment. But it also brought new vulnerabilities. In 2008, the global financial crisis hit hard. The FTSE 100, the index of the UK's top 100 companies, plummeted 31%. Its worst year on record. On a single day in October, nearly £90 billion was wiped from the value of Britain's biggest firms. The crisis left deep scars, including a steady decline in the number of companies listed on the UK market. Just as the market was recovering, it was hit by another self-inflicted shock: Brexit. The 2016 vote to leave the European Union created a fog of political and economic uncertainty that has yet to fully lift. The impact was measurable. Between the referendum and the end of 2023, the FTSE 100 grew by 22%. That sounds okay, until you compare it to the US S&P 500, which grew 125% in the same period. Part of this underperformance is down to the UK market's composition. The FTSE 100 is heavy with old economy giants, banks, mining companies, oil firms. It largely missed the tech boom that supercharged American markets. The 5 biggest US tech companies are sometimes worth more than the entire FTSE 100 combined. Brexit amplified this weakness. A confidence shock saw investors pull their money out. Between 2016 and 2020, British individual investors withdrew nearly £13 billion from domestic equity funds. But the most damaging trend has been the exodus of the biggest investors of all, UK pension funds. In the early 1990s, pension and insurance funds owned over half the UK stock market. Today, that figure is around 4%. A staggering £2 trillion has effectively exited UK equities since the year 2000. Seeking diversification and de-risking their portfolios, these giant funds have turned to global markets and bonds, starving domestic companies of a vital source of capital. This has been a major contributor to what's called the UK valuation discount. The fact that British companies often trade at a significant discount compared to their American or global peers. They're seen as cheap, and not always in a good way. This brings us to the present moment, a period of intense soul-searching for the city. The market is caught in a strange paradox. On one hand, its perceived cheapness has triggered a massive acquisition spree. Well-capitalized overseas buyers are snapping up British companies, with over £40 billion worth of takeover deals on the table in the first half of 2026 alone. While this signals that buyers see value, it also means more companies are disappearing from the public market. The number of listed companies has been falling, and London has struggled to attract major new initial public offerings, or IPOs, with many promising UK tech firms choosing to list in New York instead. In response, the government and regulators have unleashed a flurry of reforms, a kind of Big Bang 2.0 inches in slow motion. The goal is to make London a more attractive place to list and invest. In 2024, the complex listing rules were radically simplified, tearing up requirements for a 3-year financial track record. Rules were relaxed to allow founders to retain more control after an IPO, a key feature that often attracts tech firms to the US. Policymakers are also desperately trying to lure the big pension funds back. The Mansion House Accord, a voluntary pledge by major pension providers to invest more in UK private markets, is a key initiative. But progress has been slow. The government is holding the power to mandate investment levels as a last resort. They are trying to reverse the flow of capital, to get British institutions to once again invest in British enterprise. The London Stock Exchange itself is also changing. It's no longer just a marketplace for shares. With its massive $27 billion acquisition of data firm Refinitiv in 2021, its parent company has transformed into a global financial data and analytics powerhouse. The future, it seems, is as much about selling data as it is about facilitating trades. From the clamor of a coffeehouse to the silent hum of data centers, the history of the UK stock market is a story of constant, and often brutal, adaptation. It rose to dominate the world, was forced into a radical reinvention to survive, and now faces a profound identity crisis in a post-Brexit world. It remains a major global financial center, but one that is fighting to redefine its purpose. The challenge of attracting new companies, of reversing the colossal outflow of domestic capital, and of proving its competitiveness against New York and a rising Europe will define its next chapter. The story of the London market has never been one of quiet stability. It is one of enduring resilience in the face of perpetual change. If you found this interesting, subscribe today. And remember, stay money mad.